I mean, it's inevitable interest rates are going to rise. So how does that affect us?
Welcome to the show that takes up no more than 5 minutes of your time, but could help you gain massive real estate knowledge. It's 5 Minutes in Real Estate with best-selling author Shane Willis.
So I got a lot of response on social media last week. On one of the posts that I posted up, it was for Friday's stock market. I posted at the beginning of the day saying that the Fed is really hinting on raising the Fed rate, and the stock market opened 100 points down. Well, it actually wound up closing almost 400 points down. So I got a lot of questions on how that really does affect us here in real estate. What does that do initially, and what does that do long term? So I want to do a quick podcast on, some basic stuff on how that does affect us here in buying and selling real estate. So let's talk about how that happens. I don't really want to get into a full MBA class on what it actually takes or how it works, but let's talk just some generics. Basically, the Fed has the Fed rate, which affects the Treasury rate. These are investments that banks invest in, and these are also investments that individuals and corporations invest in. If you want very, very low risk, almost non-existent, you invest in a Treasury yield. If you want to invest with a little bit higher risk, but still a pretty manageable risk, you invest in mortgage-backed securities. Now, that is affected by the Treasury yield. What the banks will do as far as your mortgage rate is they will look at the Treasury yield, and as it rises and falls, so will your mortgage rate, because they're competing for investment dollars. If I'm out there trying to get you to invest $10,000 into my investment and the Treasury yield pays 1.2%, but I can get you a mortgage-backed security for 3.2%, well, you're going to have a little extra risk because the mortgage-backed security could default. Whereas the Treasury, I don't think has ever defaulted. I know we thought about defaulting once, but I don't think we ever did default. So there's almost zero risk there, but you're getting a better rate return with that 3.2. But if the Treasury yield rises, the Treasury yield is based on what the Fed rate does. So if the Treasury yield rises from that 1.2 up to 2.2, well, now there's not as much reward if we kept mortgage rates at 3.2. So we need to raise the mortgage rates to 4.2 to compensate the investor who is taking the same amount of risk, but they're now getting a little bit better return because they could just go to Treasuries and get 2.2% as opposed to the 3.2 we were offering. So your Treasury rates affect your fixed mortgages. Your Treasury rates affect your fixed mortgages, and your Fed rate affects your adjustable rate mortgages. But the Treasury rate's tied to the Fed. Okay, so there's a whole bunch of very quick, very, very elementary of why the Fed's when they raise rates, mortgages have to rise. Let's get to how does that affect us? Why do we care if the mortgage rates rise? It's because our purchasing power goes down. Let's look at it, and I'm going to say let's just talk about a 1% interest rate rise. Okay? You have got, regardless of what interest rates are in the market, as a buyer has a certain amount of principal and interest, tax and insurance they can pay on a property. And that's based on their debt to income ratio. No matter what the market's doing, I can only afford X per month. So that X winds up having a certain purchasing power. Now let's go with 20% down. We're just going to do your conventional loan, okay? And let's see what happens with a principal and interest payment of, say, $1,000. Well, if the rate's 4.5%, then you can buy a $245,000 property, and you can have a principal and interest of $1,000. But if it rises just a point, just 1 point, to 5.5%, your $245,000 max purchase price just dropped to $219,000. So 1 point dropped you 8 to 10% of your purchasing power. So you're making the same amount of money, but because the mortgages are a little more expensive, then your purchasing power has gone down. And we've seen here along the Gulf Coast prices rising. Well, this is going to affect sellers as well, because if we cannot afford it, then prices will stable off some. And we're probably going to wind up seeing, the slow growth that we've been seeing, 4, 5, 6% a year, which we've been seeing year over year. But we're going to have less buyers in the market at certain price points, or the price points are going to have to start coming down, which could affect the prices of properties. They could come down a little bit. We're starting to see some of that in anticipation of the Feds raising rates with some of the builders. I'm seeing some of the properties come down just slightly, not much. But think about it. If we go from 4.5% to 5.5%, my $1,000 principal and interest payment, I could buy a $245,000 house, or I could buy a $219,000 house. Well, let's say they only drop it a half a point, so it goes from 4.5 to 5%. Well, that still drops $10,000 off my maximum purchase price. I could have purchased $245,000. Now I can only purchase $235,000. And what if they go 1.5% from 4.5 up to 6? Well, then my $245,000 purchase dropped to $208,000. It's simple math. But that's why when the Fed says they're going to raise rates, the stock market and the bond market start to get nervous. You see those drop. That could affect our economy in whole, because the housing market is a big boom towards our national economy. So hopefully that helped educate just a little bit. And with these historically low rates right now, if you're even thinking about buying or selling, you may want to reach out to me. Let's talk a little further, because this may all start to really be affected in 2017. Thanks for listening. Have a great day.